Hi everyone. This is chapter 11, um, decision making chapter. So tonight, today I'm just going to cover a really small amount of chapter 11, fairly basic things. And then for Wednesday class, whether we have it in person or I record it, and I probably will end up recording it, um, we'll carry it a bit further and we'll actually go into the appendix. So, just quick as usual, um, this whole chapter is about relevant cost analysis. And what we mean by a relevant cost is any future cost that differs between decision alternatives. So, if you're going to make a change and you have a decision to make and you look at both options, stay where you are or make that change, relevant costs are the things that change between those two things. So they can be variable or fixed, but generally variable costs are relevant and fixed costs are not. And we also sometimes refer to relevant costs as avoidable cost. And note that you can do a total cost analysis and get the same results as doing just the relevant cost analysis. It's just a shorter method to do the relevant costs only, or incremental analysis, we sometimes call it. A sunk cost is something that's already been incurred. You can't change it because it's done, so it's irrelevant. All sunk costs are irrelevant costs and should not be considered in any decision. For instance, equipment replacement. When we look at replacing equipment, we have a list of things: what the original machine cost us, what the book value of that original machine is, how much we purchased that, or the purchase price of the new machine, sorry. The new machine will have a zero salvage value, repairs to the old machine, power for either machine, and the new machine costs, and the expected level of output for the company. So which ones are not relevant? Well, the original cost of the old machine is irrelevant because it's a sunk cost. The current book value of the old machine is also irrelevant. That's a sunk cost. If you think about what book value is made up of, it's made up of the cost of the machine less the depreciation. Those are both sunk costs. The purchase price of the new machine is relevant, because if we don't get a new machine, the 7,000 will not exist. So there's a change between the two. There's an incremental change. The new machine will have a zero salvage value. Well, we're assuming the old machine has one too because they don't mention it, so that's irrelevant. Repairs to the old machine would be 3,500 and would allow one more year of productivity. That is a relevant cost because it changes. Power for either machine? No, we don't want to. That's irrelevant because it doesn't change whether we buy a new machine or keep the old one. The new machine reduces labor costs. That's certainly relevant. So you see what we mean by relevant versus irrelevant. And what that looks like in numbers, this is a differential analysis where we just look at the relevant costs. And we don't need to worry about what these numbers actually mean right now, but just note that to repair the old machine, the total costs are $23,500. To replace the old machine with a new cost, the total cost is $26,000. The difference of $2,500. And you'll see that we looked at labor, old machine repair cost, and the cost of the new machine. So we just looked at three things to come up with our number. We could have done a total cost analysis where we looked at all the labor, all the power, the depreciation, the repairs, the cost of the new machine. And sometimes this list can be extensive, so it makes it much easier to just do relevant costs. But we come up with the same answer in any case, 2,500. So additional considerations. So they've got this statement about batch level cost drivers should be considered relevant. What that means is if we have a setup on one machine that takes longer and requires more labor than the other machine, then we need to include those factors in our analysis. The other thing that we always want to look at is opportunity costs. What do we lose if we choose one option over the other? For instance, if we add a new product, would it cause issues with other product areas, lost sales, delays, reduction in production, and those types of things? So an opportunity cost is something you give up to choose one choice over another. For instance, I'm sure you have opportunity costs of being in class. And I think we've talked about this. You have to have given something up to come to class. Of course, you won't have to do that today because you don't want to be around me. At any rate, opportunity costs are relevant. Depreciation is not included in this analysis except if we're looking at tax implications. Time value of money is certainly relevant, but we're not covering that in this chapter. We'll do that in chapter 12, the next one we cover. And then, of course, there's always qualitative factors, and we've talked about this. Differences in quality, functionality, timeliness of delivery, reliability in shipping, after-sale service levels. I mean, things that we can't measure in dollars, but we know are important. They're not quantitative, measurable in dollars or numbers. It's a qualitative factor. So we always want to think about qualitative factors. We also always want to think and keep in mind, what is the firm's strategic goal? If we only focus on identifying the relevant costs, we might not connect it with our firm's strategy. So if we're looking at a make or buy decision where we outsource part of our production, in other words, buy it rather than make it, we need to know what our strategic position is before we decide to do that. If we decide to outsource it and our firm's strategic competitive position depends on the product reliability of that part or possible outsourced part, we can make sure that that's reliable by producing it internally. We might not have control if we produce it externally. So the firm's strategic placement is always important. So, relevant costs, if we look at relevant costs, we're almost always looking in a short-term focus. Strategic is long-term. Relevant cost is not necessarily linked to strategy. However, we need to look at the firm's strategy. Relevant costs are product focused, while the strategic position of the company is typically customer focused. Relevant costs could be focused on an individual product or decision or situation, where strategic considers all customer related factors. So relevant cost analysis is not enough alone. We have to look at the strategic piece. So we use our decision framework. Let me just move this down a bit. Oops. Well, you can almost see that last line, sorry. We're going to look at special order decisions, make versus lease, or make versus buy decisions. Decision to sell a product before or after additional processing. I don't think we're going to spend much time on that. Short-term products mix or service mix decisions, we will do that. Profitability analysis, do we keep or drop products or services? If you remember right from 212, we covered most of these in 212 very quickly. So we'll spend a little bit more time on them in this section. Okay, now what I want to look at is some examples. I am going to upload you'll have your spreadsheet uploaded that you can follow along with what I'm doing. I'm going to switch over to that right now. Okay, this is your spreadsheet that I have uploaded for you. The first one we'll look at is 1117. And I think this is probably big enough because you could probably zoom in, but let me make it a little bigger. It might be helpful. So it says Adams Furniture receives a special order for 10 sofas for a special price of $3,000. Direct materials and direct labor for each sofa are $100. In addition, supervision and other fixed overhead costs average $150 per sofa. Should they accept the special order? Why or why not? All right, well, let's just look at it. So let's look at our sales in total for this special order. It would be, in total, would be $3,000. They told us that. Variable costs, that's direct materials and direct labor. It's $100 per sofa, and there's actually 10 sofas. So that's 100 times 10, or $1,000. So our contribution margin is then $2,000. And if we look at that per unit, and you know, sometimes it helps to put these things down, excuse me, to put these things down per unit as well. So we're going to look at this per unit. So it's $3,000 total divided by 10 sofas. We're going to get $300 per unit. Our direct materials and direct labor, which are our variable costs, are $100 per unit. That leaves us a contribution margin of $200 per sofa. Should we accept the order? Why or why not? Well, we should accept the order because the contribution margin is $200 per order. If we have enough capacity, of course, we really always want to ask that question. Do we have enough capacity? If we have excess capacity, we're making $200 extra per sofa. We do not look at overhead costs because they're not going to change if we choose one over the other. So, would it make a difference if they were operating at full capacity and their current line of sofa sells for $500 each? Yeah, it probably would. So our total here is 3,000, 1,000, and the contribution margin of 2,000. Over here, this is a total special order. Over here is our current price. It's $500 per unit. And our variable costs are $100. So the direct materials and direct labor is $100. So our contribution margin currently is $400. What's our opportunity cost if we're operating at full capacity? So we don't have any excess capacity. We're going to have to give some of this up to make this. So our opportunity cost is our sales price of $500 minus the $100 gives us $400. So we can just basically copy this down here. We probably didn't need to put it up there too, but I want you to be aware. So we're going to give up $400 per sofa to make $200 per sofa. So what is our opportunity cost? It is 400 minus 200, or $200 per sofa. That's our opportunity cost. So if we have excess capacity, yes, we should do it. If we do not, we should not do it. Okay, 1122. Another special order with an opportunity cost. So this company has a bid on a special order for 20,000 units of one of its most popular products. They currently manufacture 40,000 units in their Ohio plant. There will be no marketing costs on the special order. The sales manager wants to set the bid at $9 per unit because she is sure that they'll get the business at that price. So some other members of the firm object, saying they'll lose money on the special order at that price. So here's their range, 40,000 to 60,000 units. Their unit cost is $11 at 40,000 units and $10 at 60,000 units. And the committee does not want to bid 9 because they think they'll lose money because the unit cost is either 10 or 11. Why does the unit cost decline from 11 to 10 when production level rises? Well, one thing I can think of right off the bat would be probably fixed costs, right? So let's take a look at that. Total units of 40,000 versus total units of 60,000. We're going to do the high-low method. I think that'll be easier. So total overhead dollars at 40,000, we'll call 40 the low and 60 the high, $240,000, which is given over here. And at 60,000, it's 300,000 given. So the change in overhead dollars is 300,000 minus 240,000. The change in volume or units is 60,000 minus 40,000 or 20,000. So our variable overhead, which is change in cost divided by change in activity, the number of units. So our variable cost is $3 per unit. Is $3 per unit because we're going to take change in cost divided by change in activity. So then we need to figure out our fixed costs. Let's do it at the high level. So total overhead at 60,000 units is equal to 300,000. We're going to subtract variable cost from that. Variable cost is $3 per unit. So then we would take the 60,000 units times the $3. 60,000 times $3. gives us 108 in variable costs. Let me just put a border on this. That would give us our estimated fixed cost of 300,000 minus 180,000. So we think our estimated fixed cost, so between 40 and 60,000 units, is $120,000. So we're saying that because we have fixed costs included in here, unit production goes down when we move from 40 to 60,000. So the fixed overhead per unit at 40,000 units is the total fixed divided by the number of units. So we're going to take our total estimated fixed costs divided by the number of units, 40,000. That gives us $3. And I'm going to put that formula here. Total fixed divided by the number of units. That gives us our fixed cost per unit. At 60,000 units, again, our total fixed cost divided by 60,000 units gives us $2 per unit. Same formula. So our fixed overhead per unit goes down because it's a fixed cost. It didn't change, and it's divided over more units. It goes down by $1. So our unit cost went down by $1 from 40 to 60,000. Why does the unit cost decline? Because fixed cost per unit decreases as production level increases. So what's the impact on short-term operating income if the order is accepted at the price recommended by the sales manager? Well, let's take a look at that. First, let's figure out our total variable costs. That's the relevant cost because our fixed costs are not relevant. Let's do it per unit. So our direct materials per unit are the cost of our direct materials divided by the number of units. So 80,000 divided by 40,000. Cost of our direct labor divided by the number of units equals 120,000 divided by 40,000, or $3 per unit. Our variable overhead is 240,000. Oops, nope, it's not. Because remember, this 240 includes some fixed costs. What's our variable overhead? Our variable overhead is this $3 per unit. So our total variable cost is $8 per unit. That $8 per unit is the minimum amount we would accept. Because all we have to do is cover our variable cost. What would we ask ourselves? These other factors. So really, do they have sufficient capacity? Make sure there's sufficient capacity. Let's take a look at sufficient capacity. It says the plant is operating at 50% capacity. So what is capacity then? If they're operating at 50% and capacity is 40, or they're at 40,000 and capacity can go another 50%, in other words, double it, they're operating at half capacity, we could operate at 80,000. That's our capacity. Our current production is at 40,000. So our excess capacity is 40,000. And this special order is 20,000 units. So it does operate. It does have excess capacity. Number 4, what would the total opportunity cost be if by accepting the special order the company lost sales of 5,000 units to its regular customers? Okay, opportunity cost. What are they giving up? They're giving up sales, and they told us their selling price is $20 per unit. We know the variable cost per unit is $8. That gives us a contribution margin, sales, sales, what am I doing? Minus variable cost gives us a contribution of $12 per unit. That's our lost contribution margin per unit. How many lost sales did we have? 5,000. So if it's $12 per unit contribution margin times the lost sales in units, the opportunity cost of giving up the 5,000 units is $60,000. We're not looking at fixed costs because they didn't change. If we choose to do this or not do it, our fixed costs are going to remain the same. Okay, let's move on to the next one. I'm going to pause for a second. Okay, 1130, Part A. It says at the top of these, just note this because this problem actually has A through F, and we'll do a couple of parts of it, but it says each of the following situations is independent. They just mean situation by A through F, not the 1, 2, 3. So you can ignore that statement because we're just doing 1130A. All right. This is a make or buy. So they're considering an offer from a subcontractor to provide 2,000 units of a product for $120,000. They're either going to buy them from someone outside or purchase or continue to make them in-house. So we only want to look at relevant costs of make versus buy. Relevant costs would be things that would change. If we choose to make them, we will have these costs. If we choose to buy them, we will not have these costs. So we're only looking at relevant costs. If we make it, our direct materials are 28, our direct labor is 18, and our variable overhead 16. They have allocated fixed overhead. That will not change if we choose to make versus buy. So we will just add these up. So our total variable cost is $62. We can purchase this for $120,000 divided by 2,000 units. We can purchase it for $60. Those are the relevant costs. So if we buy it, we're going to spend 60,000 times 2,000 units. If we make it, we're going to spend $62 times 2,000 units. So the difference by making it, it's actually costing us 4,000 more. So this is a decrease in operating profit if we make it. 62 versus 60. We could have also taken the difference between those two of $2 and multiplied it by 2,000 units. What questions would we ask here? We would ask, are there any of these fixed costs that can be avoided if we subcontract this out? In other words, are all of our fixed costs unavoidable? Okay, let's move on to 1127. Product line profitability analysis. So we've got this company that produces high-tech products. And they only have two products, T1 and T2. Sales for T2 are decreasing and the purchase costs are increasing. The firm might drop T2 and only sell T1. And you can look at their statements here. This is what they're all looking at. They're looking at T1 having operating income of $37,000 and T2 having a loss of $15,000. What's the expected change in annual operating income by dropping T2 and selling only T1? So let's just do some analysis here. So sales for T1, 200,000. Let's just run some percents just to get you back into the habit. The variable costs for T1 are 70 plus 20,000 or 90,000. Just make this a little bigger for you. Sorry. So our contribution margin on T1, is not that, is $110,000. Our variable cost ratio is variable cost divided by sales. Our contribution margin ratio is contribution margin divided by sales. T2, sales are 260,000. Our move this over a tad. Our variable costs are 130,000 plus 50,000, or 180,000. That makes our contribution margin 80,000. Percents, 260 divided by 260. Contribution or variable cost ratio is 180 divided by 260. And contribution margin ratio is 80 divided by 260. Okay. So the incremental, hold on. So find the expected change in annual operating income by dropping T2 and selling only T1. If we drop T2 and sell only T1, and furthermore, they said that if T2 is dropped, sales of T1 are expected to increase by 10%. So first we have to figure out what the incremental contribution margin is for T1. And we're using contribution margin, so we don't have to go back and do all the other calculations. And that's the only relevant piece is the variable costs, right? Sales and variable cost. So this would be 110,000 times 10%. That's our incremental contribution margin for T1 if we drop T2. So I'm going to put that here times 10%. The loss contribution margin, if we get rid of T2, is minus $80,000, right? Because that's going away. We're going to make 11,000 more in contribution margin on T1, but we're going to lose 80,000 in contribution margin on T2. So, oops, sorry. I can't seem to operate the board. So our net loss in contribution margin is $69,000. So the change in our annual net operating income is going to be $60,000. By what percentage would sales from T1 have to increase in order to make up the financial loss from dropping T2? Well, we got to make up this 80,000, right? So we want to know what number, what percent times 110,000 equals 80,000. So we'll just take 80,000 and divide it by 110,000. And I'll put that formula here. Okay. Check figure for that. We're saying that sales have to increase by 72.73% in order to cover this. Not 10% as they said. Let's do a check figure. Total contribution margin from last year. That's 80 plus 110, right? Because that's both of them. If we project that sales would increase by 72.73%, will that cover the 190,000? Okay, well, let's do it. 110,000 times 1.7273, because it's an increase of 72.73%, but you also have the original 110 as well. It gives us really close. It's a rounding thing. Times 1.7273. Okay, profitability analysis. Next one, last one. So we've got this is a short-term production mix decision, and we're going to use production mixes. I'm going to go over those in detail in our next class, but we'll do a quick one here. So they give us all this information. They tell us what the direct what the direct materials and direct labor, variable overhead, fixed overhead, marketing costs, gives us all the costs, and it tells us the operating profit of each one. So the problem is either Flash or Clash alone can be sold to keep the operating plant at full capacity. However, labor capacity in the plant is insufficient to meet the combined demands for both games. In other words, if you needed to make as much as you could sell, then you don't have enough labor to do that. And then it makes this statement, flash and clash are processed through the same production department. What does that statement means? Well, it really just basically means that if we get rid of one of them, it doesn't change the total fixed cost because it's the same production department. We don't have to get new materials. We don't have to get new equipment. We don't have to do any more overhead. So really getting rid of one so that means that we can ignore fixed costs. They're irrelevant, right? We can just look at variable costs. So the selling price for flash is $250, clash is $140, variable cost is $200, $100 for clash. Oh, let me just add up how I got that for you. Sorry. So variable cost for flash is 50 plus 100 plus 50. Clash is 25 plus 50 plus 25. So our contribution margin is 50 for flash and 40 for clash. What is our constraint? Our constraint is labor capacity. The number of labor hours is the constraint. So the question is, which one do we produce? Do we produce flash or do we produce clash? First, let's figure out how many direct labor hours each one uses. They didn't directly tell us that, but they did tell us that it costs $100 for flash and we pay $25 per hour. So we'll take $100 cost divided by what we pay at $25 an hour and come up with 4 hours. The direct labor dollars divided by the rate per hour, and that gives us the number of hours. And we'll do the same thing for clash. $50 total divided by 25 per hour gives us 2. We want to know what our contribution margin per labor hour is because we're trying to maximize our contribution margin. So we're going to take our contribution margin and divide it by the number. Oops, what did I just do? Our contribution margin and divide it by the number of hours. So our contribution margin per direct labor hour for flash is $12.50. $40 divided by 2 is $20. We want to make as much contribution margin as we can using the direct labor hours we have. So we will produce clash until we meet as much demand as we can and then use the excess demand to produce flash. So flash would be just extra money after we make our $20 per direct labor hour on clash. Even though flash has a contribution margin of $50, if we want to maximize our direct labor, then we want to use clash. Okay, that's all I have for you today. I will see you on Wednesday. I think we should just plan on doing a virtual meeting, and I'll do a recording too. But you can log in with any questions about this or that section as well. But I think the recording will help because you can pause it while you're working through it. Okay, thank you, and I'm sorry not to be there.